YouTube, what's good? I am Kels, and welcome to the Kels Capital channel. In today's video, we'll be going over futures versus options and which I think is best in my opinion. So, I also will not make this video crazy long, so without further ado, let's get right into it. So, to kick it off, we're going to go with futures first, and I would say first pro would definitely be spreads. So, with things like NQ, which is NASDAQ, you have ES, which is the S&P 500. You have GC, which is gold. You have NG, which is natural gas, and you have CL, which is oil. So NG spreads are going to be NG spreads, and NQ spreads are going to be NQ spreads. So whenever spreads are definitely consistent and they're good at that, that's always a pro in my opinion. So that's definitely first pro. Second pro, I would definitely have to say a faster exit time. Not to say you don't have the same amount of time to exit a trade with options. When we get to options, I'm gonna explain why I'm saying it this way. But to stick with futures, I would definitely say faster exit times is just a click of a button, and that's it. No ifs, ands, or buts about it. No spread being widened because you decide to get out what you're getting out. That's definitely a pro. So that's pro number two. And last but not least, for the last pro, I would definitely have to say you have a lot less things to look at in terms of instruments to trade. Now, that can be a pro and a con. I have them for both. But to stay with the pros, I would say, let's say for a day, you come to the charts and it's kind of ugly or it's choppy, whatever the case may be, and that's across all charts, whether it's GC, ES, or NQ, whatever the case may be. So you just don't trade for the day. So that's always a plus in my book. I didn't lose any money. I didn't make none, but I'd rather walk away for the day with no money lost. That's always a plus. So that's that. So to get into the first con for futures, I would definitely say it would be the less opportunity portion. Now, the reason I said it is a pro and a con, now we on cons. So I would say it's a con for the simple fact due to with futures you can only trade indices and/or indexes. So with options, I can go ahead and I can trade a Costco or American Express or a Mastercard. I can trade individual companies that make up those S&Ps or that make up that Nasdaq and/or NQ. But when you over there with futures, you can only trade indices, which can lessen the opportunity. Like I said, there's always more opportunity somewhere in the market, somewhere. But if you only stuck with indices, it's less opportunity. So in my opinion, it's a con. So for the second con, which would definitely have to be the last con because it's really not that many for futures in my opinion. But the second con I would definitely have to say, or the last con, I would definitely have to say you can lose more money than what you're actually willing to risk on a trade. So it's not the same with options. I'm sorry, it's not the same with options, but with futures you can lose more money. So let's say I put a trade in and I walk away and I forget to put my stop loss in place. So let's say by the time I come back, I'm only willing to risk 200, but I come back, I forget my stop loss. Now I'm down 300 or 400 or $500. So that's definitely a con in my opinion, and it's not the same with options. And we're gonna speak on that right now. So to kick it off with the first pro with options, and so just to keep that ball rolling, when I spoke on the con for losing more money with futures, I'm gonna get why you can't lose more money with options. So to kick that off, that's the first pro. So let's say I get into a contract. The contract is for $242 or something like that. So no matter what, if that contract goes against me, that's all I can lose. I can't lose any more than the $242 I put on that contract because that's the premium. That's all I put in, so that's all I can lose. Now, I can definitely make more than that, so that's always a pro and a plus. So the second pro I would definitely have to say would be more opportunity. So with options, you can trade more than just the indice. I can trade an ETF, which is not the same as an indice. I can trade an ETF. I can trade an indice. I can also trade individual stocks. So let's say NQ isn't looking too well. So NQ ain't looking too good. So I can still go inside of the companies that are within or QQQ for options. Let's say that. So with QQQ for options, let's say it's not looking too well. So I can go inside the individual stocks that make up for QQQ. So let's say I do Apple or Nvidia or Tesla or something like that. I can do those individual stocks that make up QQQ. So you have more opportunity everywhere. So where I think it's well over 6,000 or 5,000 stocks on the stock market, that's a lot of stocks to choose from. So it's always an opportunity somewhere to get into a trade or to swing, whatever the case may be. So that's definitely a plus in my opinion. And last but not least, the final pro for options I would definitely say is averaging in. So the best way I can sum it up. Let's say I'm gonna use my pen. So let's say I get into a trade, right? So this line will represent the mark I need to be able to profit, right? So this is my profit line. So let's say I enter a trade and the trade goes against me, but I know the trade is going to turn around eventually, right? So let's say I enter right here, right? So let's say I enter in again somewhere at the bottom because I'm in for a buy. Let's say I enter in somewhere again at the bottom right here. My average, depending on how much money I put on it. So let's say I put $50 on the trade, and I'm going to put another 50 when it goes lower to an add-in spot that I have. So let's say this is my first spot right here for my first entry, and it comes lower to about right here. My average, depending on how much I put on it, if I put another 50, I believe that puts me somewhere in the middle. But if I put, let's say, 100 or something like that on it, my average is now going to be down here. So now the point that I need to be able to make money or be in profit is not it's not as far away as it would be with something like a future. So that same example, so let's say this is my line to enter when I get in for a buy. If it comes lower, I get in right here. This line stays here, so I have two positions at that point. I got an entry here and I got another entry right here. My profit target, well, for me to be able to get in profit would probably have to be a little bit closer toward this area to probably push me into profit, of course, because I have more than one entry. I know I probably didn't explain that right, but in my head, it makes sense. And if you actually do it yourself and you actually go through it, you will see what I mean. So in my opinion, averaging in is definitely better when it comes to options. So that would definitely be a final pro for me. So to kick it off with the first con for options, I would definitely have to say is the spreads. And to give a good example of it would be when Trump had tanked the market with the tariff talk. So for those who weren't already in a selling position, if you try to enter one, such as myself, like I swing, I don't day trade. So the spreads were definitely too large. And the only reason they made the spreads too large is because they didn't want people to continue to tank the market. So that was just a really good way to, kind of, I'm going to say, create some balance until they did a circuit breaker. Now, if you do a circuit breaker in the market, that's a whole nother talk right there. That's another talk. But, definitely the spreads are definitely inconsistent when it comes to options. It's better for day traders, of course, but I'm pretty sure it still varies with them. So, that's definitely my first con for sure. For second con is definitely one of the ones I don't like the most. I would say is the volume. So volume with options is pretty much how many people are within that said contract. So let's say for something like, I want to do a good one, something like Kroger. So Kroger, I had got in for a buy. I'm gonna actually put a picture up of the trade I placed for that and what my profit was. So once again, because of swinging, it's completely different than day trading. You're gonna always have more volume when it comes to day trading than you would swinging. So this is swinging. So for swinging, the volume could be like something like 6 or 5 or 2. Those are just the people that are within that said contract that you can be able to exchange contracts with. So if it's 6 people in, let's say that's 6 people until my contracts hit my profit target. Let's say it went down to 0. So now I'm the only person left within that contract. So nobody can take that contract for me when I want to sell. So if I want to get out of my contract, I can't because there's no volume in it. That is a huge negative. Huge negative. So let's say you got all of this profit. Let's say I'm up 109% and goddamn the Western Navy is not doing it for me. I can't get out. I can't even get out. I can't take profit because there's no volume. So that is a huge con in my opinion. So I definitely try to make sure I keep my volume within a certain range or a certain number, because I know I'm not holding um, my contracts crazy long unless I do like a deep swing or something like that. So that is definitely a huge con in my opinion. So last but not least, for my final con, I would definitely have to say the Greeks. Now I know people say Greeks a lot, so I use a great example for something like your theta. So let's say I'm in a trade for like SoFi or Snow. I'm gonna put profits up for those too. I think I did those like it was like 2 weeks ago or a week ago or something like that. But I'm gonna put the profits up. But let's say I did something, for one of those plays, and let's say I decided to hold the contract for 5 months. So let's say 4 months in. So by the time that fourth month come in, by the time you get within 30 days, you start to lose more and more money on your contract. So if I didn't explain theta, theta is pretty much every day that goes by, that contract lose X amount of dollars. So that's how your theta works. So let's say I'm 5 months for a contract and I'm 4 months into it. So let's say I'm down 50% or something like that. In order for me to at least get back to break even, or at least get into profit for that matter, I would need something drastic, like some type of news or some type of earnings report or something like that. I would need something crazy to happen in order for me to be able to at least get back to break even or even in profit. So that's one of the worst things in my opinion when it comes to options trading. It's just the Greeks. To get into which one I think is best, once again, it's all subjective, and I think depending on which route you decide to go, whether you want to day trade or whether you want to swing trade. I don't day trade anymore. I didn't really too much see that much of a difference when it comes to day trading. Now, if we talking swing trading, I would definitely have to, of course, go with options when it comes to swing trading. Um, yeah, definitely have to go with swing trading options. So I'll give you a great example of it. Let's say I'm in a play like Lucid or something like that. It's not even on the S&P 500. So let's say I decide to do something like a Lucid, and it's news or reports that it's about to be some crazy investors or something like that about to invest into Lucid, the car company, the electric car company. So let's say I decide to get in for I don't know, let's say 100 contracts at $27, because Lucid is they starting to get the bearings. They wasn't really that profitable. So let's say they went from $10 to I don't know, let's say a $27 stock or something like that, and let's say, or a $50 stock, I don't know, or $13, I don't know, but let's just say the contract for 2 years at the strike price I choose, let's say it's for $27. Let's say I decide, man, it's only $27. I'm willing to put some bread on it. So let's say I'm willing to put 100 contracts. Oh, my fault. For $27 contract, let's say I'm willing to put 100 contracts, right? So let's say I'm willing to put $2,700 on it. That's all I can lose. Once again, let's make sure we get that understood. That's all I can lose. It's $2,700 unless I decide to close it earlier. So let's say Lucid go crazy, it boom. Let's say it hit 500% or something like that, or even closer to 1,000 or 300% or something like that. Those are the advantages you get when it comes to options and swing trading. Me personally, you put time on your side. I don't have to sit and monitor or be worried about if this trade goes against me. Trade is gonna go against you, of course, when you swing trading, but because you have time on your side, you cool and you're not tripping. And versus when you day trading, you kind of get your heart rate going a little bit. Price going against you a little bit. Like, man, I'm up, I don't know, $3,000 or something like that. Man, now it came back down. I'm only up 2,700, 2,500. I go ahead and take the profit right now. It's not like that with swing trading. So in that aspect, I would definitely go with options. It's more opportunity once again, and just in my opinion, it's better. But if you're gonna day trade, let's say you don't want to deal with all the noise with X amount of stocks. You don't want to have to sift through thousands of stocks. You can only sift through let's say your NQs or your ES or your GCs for gold. Let's say you only want to do that. So once again, it's all subjective. So yeah, that's just my take on it. Me personally, I'm a swinger. I'm gonna go options. So that's just my take on it, and that's definitely gonna wrap up this video. So make sure y'all stay tuned for the next one. I will get into which one I think is best, day trading or swing trading, and yeah, be on the lookout for that. And I'll see y'all in the next one. Peace.